Hi, welcome to my channel. My name is Danny Siem, and in this video, we'll be discussing what's been going on with the economy. Given the current environment and downtrend in our economy, there's a lot of confusion and unanswered questions people are having about exactly how we found ourselves in this position today. To help bring some clarity to those interested in understanding why markets crash and why they affect the economy so much when they do, I put a list together of 7 common questions most people are asking today. So to start, let's go with question number 1. So why do markets crash? Market crashes can be driven by the following factors: fear, economic declines, natural catastrophes and crises, and wars. Fear is the biggest cause of stock market crashes. That fear comes from uncertainty. When investors are uncertain of the future, they pull their investments out of the stock market and put them in more conservative investments like short-term government bonds until certainty is restored and confidence is regained. Oftentimes, 2 or more of these drivers can occur simultaneously. Let's use the current coronavirus pandemic as an example. This natural catastrophe has created fear and panic in the stock market, compelling investors to sell off their shares, believing the virus will have a lasting, drastic impact on the economy. Question number 2. When do market crashes typically happen? Based on history, they often happen after periods of rapid expansion and economic bubbles. Economic bubbles occur when there is excessive economic optimism in the market as investors buy shares of stock for more than what they are realistically worth, because they optimistically assume their values will continue to go up. For example, the markets rallied by 158% through the year preceding the crash of 1929, and by about 33% through the year before the Great Recession of 2009. Before the coronavirus crisis, stocks rallied by roughly 14% through the preceding 12 months. A similar thing happened during the housing crash of 2008. If you recall this fiasco, home values were rapidly increasing and people were buying houses like crazy to try and capitalize on the appreciation. People were willing to pay much more than homes were really worth and what they could realistically afford, because they had an optimistic assumption that values would continue to rise forever until they didn't. When the housing bubble burst, those recent buyers were left owning homes for much more than their actual worth, with monthly payments they really couldn't afford to pay. Question number 3. When and where was the first market crash in history? In 1634, Dutch tulips were the driving factor behind the first market crash in history. Yes, tulips. Tulips were first imported into Europe from the Ottoman Empire, now named Turkey. This rare, beautiful, and exotic flower created high demand among the Dutch elite, who saw the plant as a status symbol. Prices skyrocketed from 1634 to 1637, and soon speculators, even middle-class ones, began buying up all the tulips they could find as prices soared. But as interest in tulips faded, prices cratered, bankrupting speculators who assumed the run-up in value of tulips would last forever. Sounds similar to the housing crash, doesn't it? The ripple effect from the tulip crash sent the Dutch economy into a tailspin, which took years for the Dutch economy to recover from. Question number 4. When were the biggest market crashes in U.S. history? Well, there were pretty much 4 of them. The stock market crash of 1929, the stock market crash of 1987, the dot-com bust of 1999 to 2000, and the Great Recession stock market crash of 2008. The stock market crash of 1929 was the first major U.S. stock market crash to occur, essentially causing the Great Depression. The Dow tanked 89% from its pre-crisis peak, and the decline occurred over a period of about 34 months. Before the crash, homes, cars, and other commodities were selling left and right, and speculators ran wild. However, many investors were over-leveraged, meaning they borrowed too much money to purchase stocks, and when the market bubble popped, those investors couldn't pay their debt obligations and fell into bankruptcy. It took 12 years for the U.S. economy to finally recover from the Great Depression. The stock market crash of 1987 is known for producing the largest single-day market loss in U.S. history, losing 23% of its value. Highly leveraged corporate takeovers and buyouts were abundant, and many of these companies were leveraging junk bonds and margin accounts. On October 19, 1987, the market turned on a dime as investors panicked and sold. With the introduction of computers during this time, computer trading made it easier for investors to sell off their stocks faster than ever before, which compounded the crash. Learning from their mistakes, circuit breakers were installed on computer trading platforms that would allow exchanges to essentially pull the plug on trading and give the market time to breathe. These circuit breakers are still in use today and have already been implemented several times since the COVID-19 crisis began. The dot-com bust of 1999 to 2000 was driven by the growth of the internet as investors' interest in internet stocks boomed over the course of the 90s. And companies like AOL, Pets.com, Webvan, GeoCities, and Globe.com saw their share prices skyrocket. Investors eventually lost favor of highly valued tech stocks and sold their shares away. The NASDAQ fell from 5,000 points in early 2001 to 1,000 points by 2002. As I discussed earlier, the 2008 crash, also known as the Great Recession, saw the markets fall by 49% over a period of 16 months, which was fueled by the widespread use of mortgage-backed securities. When housing prices started to retreat from their 2006 highs, so did the value of these products, which were held by investors, pension funds, and banks. As the number of homeowners who couldn't pay their mortgages increased, financial institutions started to suffer, and many eventually went into bankruptcy. Question number 5. Why do market crashes have such a strong effect on the economy? Stocks are an important source of cash that corporations use to manage and grow their business. If stock prices fall dramatically, corporations have less ability to grow. Companies that don't produce enough will eventually lay off workers to stay solvent. As workers are laid off, they spend less. When workers spend less, demand for goods and services drop, which in turn means less revenue for the companies, thus creating more layoffs. It's an endless cycle that compounds and exacerbates itself. If the cycle continues for any significant length of time, the economy contracts, creating a recession. As we have seen consistently through history, stock market crashes precede depressions and recessions. The stock market crash preceding the Great Depression, the 2001 recession, and the Great Recession of 2008. Stocks are also an important source of cash for those in retirement and living off their 401ks. When the value of their retirement accounts shrink, so do their ability to spend, further harming the economy. Question number 6. Are we now experiencing a stock market crash during the coronavirus pandemic? Yes, definitely. By definition, a stock market crash is when a market index drops severely in a day or a few days of trading. In just a matter of a few weeks, the Dow Jones has already experienced 8 of the 10 largest single-day point losses in history as of March 16, 2020. The market has dropped nearly 32% during this time. The coronavirus is truly a natural catastrophe that nobody saw coming, many calling it a black swan event, which is a metaphor characterized by its extreme rarity, their severe impact, and in hindsight is often inappropriately rationalized. The fear and resulting after effects of the coronavirus will be recorded in history and record books for generations to come. No one knows how long this pandemic will last, and it's that uncertainty that has the markets in a panic. And finally, question number 7. How will things look when the dust settles? This is a hard question to answer, but what worries me the most is what will our society look like after this pandemic ends? With bars and restaurants being forced to close for an unknown amount of time across many states, how will these businesses weather the storm? Will they survive long enough to stay in business when the economy recovers, or will they be forced to close and go out of business? For larger businesses like airlines and cruises shuttering operations, how will they fare? Will they be able to recover, or will our travel industry look much different in the aftermath? The answer to these questions depend on the swift and continued action of our local, state, and federal governments to work together to combat the spread of this virus. If they can't control the pandemic within our borders in a month or two, and we're still fighting this battle into the summer months, I suspect we'll all be suffering through one of the worst economies in decades. I hope you enjoyed this video and felt like you learned something from it. If you did, please be sure to hit that like button and subscribe to my channel so you'll be notified as soon as I upload new content in the next coming days. Please also comment down below and tell me what you think about the current state of our economy and what you think the future will hold for us. I'm pretty active in the comment section, so I look forward to interacting with all of you. Thanks again for watching. Remember to wash your hands and stay safe.